All right, good morning, everybody. Bonjour and hello. Hi, guys. So what I wanted to talk about is just some projections for the rest of the year. I thought that we'd bust out some charts and have a look at what we can put together for the remainder of 2014 and whatever sort of lingers into 2015. Before we get started there, the President Obama has just he has now said that he's approved surveillance flights over Syria. So for the first time ever, the United States will be surveying Syria. For what has been, I think we've been doing it for the last 30 years, but at least it's official now. All right, so I want to talk about the big ones for us. We're going to look at some euro. We're going to look at silver, maybe euro pound, stock market particularly, and we'll kind of talk about where we're at fundamentally, where we're at technically, why things are doing what they're doing, and how to recognize a change in that so we can go trading around it. All right? So over the last couple months, I mean, I've been on the short euro bandwagon now when it was going up and looked a bit silly then, and it's finally sort of cooperated on the downside. Literally been short for a year and a half, literally. So it's been a frustrating and now rewarding period, but a little more frustration than was necessary. And now we're starting to get Mario Draghi saying that the euro is going to be on an entirely divergent, or the ECB is going to be on a divergent path relative to the Fed in terms of interest rates, right? And we've kind of talked about the cycle a little bit, all right? And I'm gonna rehash this very quickly, so please stick with me. And it's going to be a little bit dry here to start with, but I'll make it as interesting as possible. So let's try to get a reasonably clean piece of paper here. All right. Now, the old days, I've been trading since 2006. So that's getting on now, what, 8 years, going 9. And one would have to pay attention to the fundamentals back in 2007, 2008, blah, 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 all the way through 10, 11, 12. However, there was enough volatility that one could afford to trade both ways with and against the fundamental bias. So I was always asked the question, David, do you watch fundamentals? And the question was, and I always used to respond with, I don't ignore fundamentals, but I don't necessarily trade with them. So in other words, I don't like to trade around fundamental events. I don't like to trade around the Fed, non-farm payroll, major things that can upset my trades, that can upset the technical sort of part of them. Now, however, with volatility at these incredible lows, I mean, even though the euro has dropped the better part of 800 pips, I mean, almost 800 pips to the, right on the money, it's taken all year. I mean, we started this in April. We're now staring September down the barrel. So although it's fallen the better part of 800 pips, it's taken, like 5 months. So that's 100 and something pips a month. That's not very much. Considering during the traumatic times of the economy, we were talking about, pound yen dropped 1,000 pips. Or 2,000 pips a day. I mean, not a day, but in one, what I mean? We had a 2,000 pip day, and we had 1,000 pip day. I mean, there were crazy things going on. Euro would move around 200-300 pips, right? Well, that, in my opinion, the real average daily range for the euro should be somewhere around 120 to 130, and the pound around 180, and the euro yen around 170. Pound Swissy right around 200, 210. We're not even close to those volatility levels. All right, so I'm reiterating the point to trading with the fundamental bias is as important as it's ever been. Okay, so the other thing to consider here, is fundamentals change very, 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 very slowly. Okay, you're talking about turning around an aircraft carrier in a harbor. It takes a long time because you could bash into things. You got to be very careful. You got to make sure you're turning the right direction. You got a nuclear reactor under that thing. You got a bunch of F-18s on top. You got to turn it around very, very slowly, very, very deliberately. Make sure you're doing all the right stuff. That is what it's like for a fundamental change in the market. It takes a preposterously long time. And that in itself is probably the single biggest methodology challenge for us as human beings. Right? Because we can go from enjoying chicken one day to being sick of chicken the next day. And fundamentals in the market don't work like that. If there's a fundamental pattern, you are stuck with that for months. And when you see a change coming up, you got to remember that these central banks are going to be sometimes months and months and months behind you. All right. So just like the euro, my thing was I see euro going down because euro is rubbish and the Fed has created this stagflationary sort of artificial thing moving forward. I use a 5 and 21 principally, 5 EMA, 21 EMA. All right, so where are we fundamentally? Let's have a look at it real quick. US, Euro, and we'll throw the Aussie into this mix just because we want some Asia here. All right, and we're going to put interest rates and QE. All right. The yen's in here, but really it's a case of my thing with Japan is that they've been stagflationary for 20 years. They're still shooting for their 2% inflation goal. Good luck with that. And really, these guys' interest rates are not going up in our lifetime. And really, it's a case of how much stimulus are they going to add to the yen, yay or nay? You know what I mean? No, not at all. Not at all, Joe. I'm happy to. I mean, the yen's obviously a massive part of what we do, right? It's just, it's just. I guess what I'm saying is it's not particularly interesting from a fundamental standpoint, because it's really a case of how much of this are we getting at one time, and this is really very important. Because if the Fed is cutting this, and these guys are adding here, very, very, very difficult for the yen to be strong in that environment, is it? Almost impossible. So this is all yen short here, cutting QE here, raising QE here. This is all stuff that's that's yen weakness orientated. The only thing that can really change this around is a flight to safety move and nothing short of a crash in the stock market, which I think is highly unlikely. All right, so literally a volatility event in the stock market of, like 3-4% moves, I think could roll this puppy over. And I'm not discounting that, but I think it's a less likely scenario. And we're kind of, that's actually a good little way of sliding into the next analysis here. So interest rate wise, where are we in the US? They are in the process of talking about when we're going to raise rates. Here's the thing. Here's the thing, guys. And this is a product of quantitative easing. And honestly, Japan, this model here, get used to it because these guys here and these guys here are now stuck with it. Well done, everybody. Your money printing policy has earned yourself Japan. All right? Stagflation. You know, we talked about this 2 years ago. Morning. In that you're going to start to see price inflation, but no wage inflation. So yes, the American economy is producing all sorts of jobs. 250,000 jobs a month, and there's actually an immigration, a deflation right now because a lot of those folks from South America are going back to South America because it's actually not particularly viable for them to be here right now, which is the first time that's happened in 10 years. Right? So, although we're producing 250,000 jobs, average wage inflation is going down. And that's the case for the UK too, like big time. So what's that telling you? That all the hiring going on right now, all the employment going on right now is McDonald's, Target, Walmart. You got people with master's degrees flipping burgers. You know, would you like fries with that, sir? Okay? And that is not necessarily... So, you know, as a central bank that's mandate is both growth and price inflation, that's a problem, isn't it? So you got your general population getting poorer, your rich getting much richer, and instead of, you know, the whole basis for capitalism was that it creates a bigger middle class. Well, now you've got a shrinking middle class, and because you've got a shrinking middle class because of this loose monetary policy, you got an issue now, because the more you lose your middle class, the more you need social programs, the more it becomes socialist, the more your middle class decreases at a higher rate, which is going to be deflationary from a wage standpoint, but inflationary from a price standpoint. So although we have a drop-off in quantitative easing from a zip here, interest rates, I think, are actually further away than you think. All right? But the language right now from the Fed is, yes, we will be raising interest rates. So we will go on that for now, but trust me when I tell you that it's further away than you think. It's the aircraft carrier analogy. This is out there, man. Interest rates in the United States will not be here by the end of the year. We were lucky to see them by June, maybe. Okay? But we're going to put a little up arrow here. Actually, we're going to put a little sort of a sideways to up arrow here. UK, still quantitative easing. Talks of coming off it because of really just following behind the Fed. So we're going to put sort of a sideways down arrow here. Interest rates, no. No sign of interest rates there. Manufacturing in the toilet. There were rumblings of interest rates following, you know, being the first to hit, but no. Okay. The Australians are in total pause mode here, and I think about to see a pretty good crash in the housing market, and obviously no quantitative easing. Euro, these guys are starting a QE program, and interest rates are no. So what is this fundamentally here? If we were going to give ourselves a fundamental rating in terms of, because you always got to remember for currency, the only thing that matters is yield and the anticipation of yield. Guys, if I've taught you one thing today, that's it. Fundamentals that drive currency are yield and the anticipation of yield, and that is interest rates. That is the only driver of foreign exchange in the world. Yes, there's other things. There's transactions going on in the world. There's, you know, the car manufacturers are running to Mexico because of the dollar hedge, etc. Yes, there will be transactions sort of moves within the context of that. But this is what drives fundamental currency trends. All right? So where does this leave us? If we're rating these in terms of anticipation of yield, but David, why would the dollar get strong relative to the Aussie if Aussie interest rates are higher than the dollar? Because the stance is different. Because America has America's pondering raising interest rates, the Australians have paused. So even though the yield differential is higher in the Aussie dollar, the anticipation of the switch in yield will make the dollar slightly stronger. I hope that makes sense. Okay, so if we give these guys a fundamental rating, the US, 1 being the weakest, 10 being the strongest, we'll give the US a 7. We'll give the UK a 5. We'll give the Aussie a 5. We'll give the yen, not because Japan is in the toilet, but just because it's not going anywhere. And it's just a matter of how much more stimulus is going to come into the market here. So we'll give these guys a 3. And we'll give the happy euro a 2 for now. Notice here that nobody is an 8 and 9 or a 10. All right? Everybody's kind of just mediocre to low here. So really the trends for the next 6 months at least will be on this track, won't they? So what does this mean? Euro USD down. Euro pound down. Euro Aussie this way down. Pound USD kind of this way, if not a little rangy, I think. A bit of range bound action. Okay. The Aussie USD rangy. Okay, USD yen grind to the upside, sort of sharp down moves with the stock market retracements, grind to the upside. So here you're probably looking at, like a 106 to 102 range. Okay, but we can look at these charts in more defined detail. But to me, fundamentally, for 6 months, this is the pattern that we're in. Would you agree with that? And the central banks, particularly the Fed, is just going to be the noise that we continue to hear, right? Out of Janet, a.k.a. Grandma. Yes, we're going to continue to trim QE. Euro Aussie, I think we're going to more down there. This is what we're going to hear from Grandma. Yes, less QE, but we're still waiting on interest rates because we're looking at a multitude of economic indicators and statistics, not just one thing. They kept giving us these thresholds. Oh, well, 6.2% unemployment, and then they just changed it. They're like, I know that's not a convenient number. Well, pound dollar, pound USD. I think you're going to have sort of down to rangy. I'll show you that in a minute. All right? But fundamentally, this is where we are. And I've spent 19 minutes basically telling you status quo. Okay? So, how does that translate to the euro? Euro is fundamentally weak. Draghi's even told us that the ECB is going to be on a divergent path to the Fed for the foreseeable future. He's told us that. Plain English. Right? No interpretation required. Now, that's important. That's telling you to be a bear. I mean, it's just, don't overthink it. All right? Now, one thing that's interesting, though, is that the Commitment of Traders tells us that short positions in the euro are 20-month highs. And this to me is partly because there's very little else to trade. So people just getting, the dollar looks good by default more than anything. Not because the dollar is particularly great, but because the other stuff is less great. All right. So where are we going on the dollar? I mean, on the euro? Let's have a look at our little dollar index here. This trend line is obviously very attractive. And that would intersect, I don't know, somewhere around 84, and we're at 81.74. So that speaks to right around 130.50 on the euro. 1 point in the dollar index equates to 100 pips on the euro, roughly. Dollar index is 60% euro, so really it's just an inverse relationship with the euro principally. So it's at 81 and change right now. So 82.48, looking for 84. That's another 150 pips. That puts us 130.50 as the significant support. And you look to the left here on this. It's a monthly euro chart. You can see there was lots of stuff sort of lingering in that area. All right, and just visually on this chart, that looks like a decent zone. And the monthly stochastics halfway down. Honestly, I think that this is more something like this. Because this rollover cycle here is going to take months and months and months and months. Even when the stochastic gets to the bottom here and starts to turn up, that even though it's going to look like it's oversold there, that's going to be like halfway through the cycle. It's really almost a 2-year plan, yes. And then even when it does this, it's still bearish. It's going to do kind of something like that. It's just how these things go. Much like this, much like that. Remember I said these fundamental cycles are like turning around an aircraft carrier and a hopper. It takes a long time. And as a result, you can have this kind of thing on the euro. Hello, major retracement. Push to the bottom again. So really, so let's get a little more accurate with it. Remember I said to you that we had 20-month highs in the short interest on the euro. So this thing, how much more fresh money are we going to get into the euro short side where we are? It's going to be tough. It's going to be tough. But are we already interested? To me, the euro is a case of sitting back and just playing. Ideally, I'd like to see stuff here around 33.20 all the way to 34.20 in this box for shorts, looking for 130.50. All right. So 30.20. Let's see. Hello. 30.20. 60. 34. Looking with a target of 30.50. And I believe this is also the 50% of this whole rise is at this zone. So, I mean, that's a big time area. Right? And then really it'll be a rinse and repeat down to the 128 zones, something like this. Something along these lines. Then we put around it and make the same move back to that 34 area and then probably down to 128, something like that. And that's a weekly chart. And the reason I'm sort of drawing such a choppy picture is, one, there's a ton of support here, right? This is a big time deal. It's 130, the cycle level. It's a 50% of the whole rally rise going back to 2012. There's visual stuff all over here. There's just a lot of things. And you're going to see multiple bounces off that area. I have no interest in longing that zone. Only waiting on this area to short. Between 30, it's a wide zone, 32.80 and 34.20. And I don't care if it goes into the 35s. Really, it's not. That's even better. No, not long it. I would not long it for those fundamental reasons I talked about. Okay, I will say this, though. I think that the euro will recover quicker than any other economy. Because the Europeans are willing, begrudgingly, admittedly, but they're willing to go through the necessary pain of restructuring to get this right. I don't think the UK and the US are prepared to do that. We need to live in our little bubble here in the States. You can't tell us that we have to go without. So in the interest of not going without, we're not going anywhere forward. All right. So yes, I am absolutely a Euro bear. Will continue to be a Euro bear for 12 to 18 months. But when this thing bottoms out, it's going to get to 140, 150 quicker than anybody expects. And I think that level is somewhere around 118. All right, but I think it's short until then. Okay, and really, I would just plan on continuing to short the mid 33 to mid 34 area for the remainder of the year. Looking initially for 130.50 and then into the 128 zone, and then you talk about a big retracement all the way back up to the 35s, and you're going to try and take that thing down 2,000 pips, literally. And then look out because, late 2015, early 2016, I expect it all to switch around, and people realize that the Fed's printed $4 trillion and the dollar's going to fall. There's going to be all sorts of noise about the dollar losing its reserve currency status and crazy things. And despite the Fed, because I think the Fed's going to disappoint on interest rates. There's just no question about it. People are going to be thinking, 4 or 5%, no, and they're stuck at like 0.5, 1% for a long time. Joe, to be honest, I've never looked into that or I've never looked into that as a strategy, to be honest. It might be absolutely valid. Yeah, that's lukewarm, but to be fair, I've never looked at it specifically. Geopolitical stuff, to me, that's another reason just to be reasonably bearish on the euro is just because, you got Vlad marching into the Ukraine. Hi, Ukraine, you need humanitarian help? Let me march 50 armored vehicles into your country. Sound good? No, we're not that excited about that, Vlad. We're gonna park them here anyway. Yeah, I don't think, guys, the geopolitical stuff is going to be noise in your ear, but it's not. Like I said to you, it's all about yield. It's all about yield that's important for currencies. So that fundamental picture I laid out will not change if all hell breaks loose in Ukraine, or if ISIS goes mad. It will not change your currency picture. It doesn't help it, and the media is going to be all over it, but just cut through all that noise. All right, so that's the euro. It's pretty. The euro for me, I'm just hanging out, waiting to be a bear. Yeah, I mean, on the short term, I'm expecting sort of 31.40, and then we go back to about 32.50, 32.80, and then head down to that 30.50 mark. So something like this. Something along these lines. You got 31.40 as weekly M1. So I'm expecting kind of a little something like this. 31.40, 32.80, right back to where it started from. Something like that. And once again, I have zero interest in this trade. Zero interest. Awesome, it's going up, brilliant. I'm just going to wait to get short here, and if it pops up a little bit more, wait to just load the kitchen sink in this area. And then 30.50 is the target for both trades, those stops. All right, so that's my plan on those. Okay, so let's talk about the stock market situation here. Yeah, I use a 5 EMA and 5 EMA and a 21 EMA. That's it. All set to close. Just as happy to go without them though. One thing I do want to point out on the euro before we move on the EMA front is this. Notice the gap, precisely, yes. The gap between the between this 5 EMA on the weekly and where price is, one would expect that gap to be filled before price will continue down. Just look at our candles operate. You either wait for it or you go back and fill it and then you continue down. Hence why I said, hey, like a 31.40 of the weekly M1 support back to that 5 EMA vicinity, which also happens to be these lows and highs. You know, there's a lot of selling and buying interest there. I would expect that to be the next drop point, and then you're talking about the next support, which is the 50% of the whole rise, and the visual area of 30.50. So that's why I'm waiting for that short. You know, call it 32.70 to 32.90 down, looking for 30.50, 30.60. All right, that's the shorter term trade. You know, and then you talk about this again, and that's a great trade there. Something you can really load the boat on. All right. Okay. So let's talk stock market here. It's possible that you are this guy. It's not an impossibility. I'm totally been that guy for a while. All right, just growing old and gray and just withering away, waiting for a stock market decline. It's, you know, and here's really the nuts and bolts of this. I'm gonna get the futures chart in here just because I can get more data. All right. There are fundamentals in play here, but principally this is what's going on. You know, the free money bandwagon is obviously still going, and the stock market's going up in good and bad news. Oh, it's bad news. Yay, that's going to be more free money from the Fed. Let's hang on to the longs. Oh, it's good news. Oh, you see, the economy is improving. Let's buy more stock. A lot of the S&P and a lot of the U.S. stock market momentum is because it's the best option of a rubbish bunch. Okay? And, you know, it's becoming more difficult. It's becoming more difficult to be a trade stock indices, yes. It is, you know, because here's the thing, is that yes, the euro's been bearish, but it's moved 20 pips today. The pound has moved a grand total of 25 pips. Aussie, absolute ripper, up 40 pips. the currency market has tested my ability to keep my eyes open more than any time I've ever traded it. So for me, on the Forex side, I put in trades where I want to put them and just go and do other stuff like silver in the stock market. Much more time on stocks than anything else right now, and building this private equity fund. All right. So to me, I'll get rid of this 21 EMA. It's kind of incidental. This channel on the daily, in my mind, is the most important thing going here. Okay, we had on the file recently, we had this little trend line. And for all the money, it looked broken. On the spot chart, it actually looked more broken. It looked like this. So on the spot chart, one's thinking, hey, we'll just retest that. No. Not valid, and then you got this going on. Something like that, and you're thinking, oh yeah, this is a break, I'll just measure this. And project that down, and that's fine. Because, that's a short-term thing. This channel on the S&P, to me, is way more important. Okay? And if one looks up here, that's right around sort of 2012 in there. Okay? Now, here's what I want to show you. All right, so on the weekly chart, I'm expecting something like this. It cruises up there, it visits it, might even penetrate the high a little bit. I mean, that's as high as 2030. Okay, it goes hello, and then it can't do it, so we come back down to the bottom of the channel. All right, we measure the width of this channel. You project that down. Unlikely, and the reason why I don't think it holds it on the second drop is one, because it will be essentially a failed break of 2000, and it's at such a steep gradient here that it's not sustainable in my book. And even though the stochastic's now pointed up on the weekly, this is a classic example of a bearish stochastic that's going to do sort of something like this. A continuation down. After what is a failed break above 2000, then you measure this, excuse me, you measure this channel, project that down, and you're talking about 1800. I'm not, and this will be a very controlled move here. All right, and you're going to hear all sorts of stuff, all sorts of noise in the media about, geopolitical this and the Fed cutting off money and owned by stocks and all these other different things. Ignore it. This is just normal, healthy move, and you're going to see sort of 1860, and then a move up to 2100. And what will probably happen there is the mechanics of it. You'll fall right back into this trap. You'll fall right back in there again. You'll get something like this going on. Oh, okay, break, retest, grind its way down, picks up the bottom, cruises up, uses this as support. It looks like the inverse head and shoulders, and then you'll latch on to this channel again. Just keep riding the channel. Okay, so to me, the trade plan is sort of 2015, and I'm going to make this a wide sort of area, but I think it has to be because there's the potential for an overshoot. Short, with a target of 1860, and then long 1850/60 area, looking for 2100. and then wait and see, right? And this should take the better part of 6 months. I think this is the 6-month program, yeah. So that's my 2 cents on this. I don't think it's particularly dazzling. I'll show you another thing. If the moving average stuff is more important, So in summary, we have a 3350 to 3400 short to 3050, and then back down to 128 on the euro, and then right back to where it came from, and then all the way down to like 2000 pips. Yeah, sounds like crazy talk, but I think it's on the cards. All right, then stock market 2015, 2030 down to 1860, and then all the way up to about 2100. So happy to take that both ways. All right, and this rally here is, it's a pretty obvious spot. It's a pretty obvious spot because I believe this to be the 382, the major rise, and it's, there's so much support around this 18.5 area, it's ridiculous. I'm not going to get time to look at the CAD today. I only got 4 more minutes on it. So if you don't mind. It'll fill the gap. I have 3140 up to 3280 and all the way back down again. Guys, what charts do you want me to look at? I can always post them on my Twitter this evening. How about I look at a CAD, and I'll do a CAD and maybe pound and euro pound for you. Okay. And that's oops. Sorry, Joe. Need to be to everybody there. Okay, so that's my thought here on the S&Ps. Oh, one other thing. I got a frozen chart here for some reason. Do you guys hear me? Not sure why this is bombed. It'll come back to life. All right, let's quickly. Let me try to find a. Sorry guys, 1 second now. Right, this will do. And if you trade, and the reason why I'm bringing up silver and not gold is because I think silver is just less complicated. Gold, you got a lot of grubby pause in there. You've got a lot of people inflation hedging, risk aversion stuff going on. Too many cooks there for my liking. I think that silver is a lot easier to interpret. Okay. Here's the thing that I've been watching on silver is this. This chart looks a little bit funny, but don't worry. We'll do the same thing. This trend line to me here is the bee's knees and cat's whiskers. Okay? And essentially I'm looking for silver to do something like this. It went up to almost $50. it's come down to 19 and change. Is silver fundamentally bullish? I don't know. I think that it's going to come into favor just because people are going to think it's cheap. And money has to go somewhere. And if there starts to be a little bit of a 25% pullback in the stock market, 15% pullback in the stock market, and the dollar falls out of favor even for a little while, I think that money will move to some metals, particularly platinum, palladium, silver. All right? And it's very convenient that we have this monthly trend line going back 5 years. Okay? That's also going to clip the top of this range here around $17. All right? And if we take this little flag, this little continuation flag, and we take that measurement, we project that down, you're going to be right into that area. So essentially, I'm looking for silver to do a little fake break and then back to run around this 23 handle. And then it's a good possibility it's going to sort of cruise to the bottom again and range around like it did before. However, this is a really good trade. To me, that's very high quality. You're talking about a move from 17 to 23/24. So a $7 move from 17. That's a chunk. It is used a lot, yes. There is definitely, there's definitely sort of a demand, just a raw demand story for silver. You're absolutely right. And it's, like I said, there's sort of less silly speculation in silver, in my opinion. It's not as convoluted as what I'm seeing in gold, So, in summary, I'm looking for it to drop right around to 17, maybe early 18s, and then a move back to right around sort of 26. So 17 long to, I'm going to say 24 to be conservative, option to go to 26. I think it's a very high quality trade. Start off small and just build a position in this area, I'm going to start off small and start building stuff between 18 and 16 and try to make $7, $8 out of it. That's a big trade, guys. Okay, so I'm out of time, but we've lined out where we are fundamentally. We talked about where to short the euro. We talked about where to short the stock market, where to buy the stock market. And we talked about a silver long. And these trades are long-term positions, aren't they? I mean, we talked briefly about some short-term euro stuff, but these are like trades you can fire and forget, positional sort of things. Okay? On my Twitter, I'm going to probably by end of London tomorrow, I would think. I would look for Euro 31.40 up to 32.80, however long that takes. Day or two. On my Twitter later, I'll post the Euro Pound chart, CAD, cable, maybe some Euro Yen. Okay? So I hope you learned a little something, and good luck further, everybody, and we'll chat to you guys next month. Thank you.